Let's talk about market performance, still subdued, and we're told that month on month the declines are now over 6% for the bourse. I mean, I think that's quite serious.
Yeah, actually, and I mean, year on year, actually, up to now, it's at about 15%. Yes, it's pretty serious. I think we're one of the worst performing markets in Africa at the moment. I mean, and basically, we expect it to keep to maybe decline further somewhat. I think all you can tell investors is to keep cost averaging as it comes down, because it will hit at bottom at some point.
I mean, we were told that having a very negative bearing on the market, obviously, is the inflation situation, a depreciating currency, and Kenya's vulnerability to international forces. What's needed to lift the market?
At the moment, I think apart from investors running from the Kenyan market and the weak shilling, there are other external factors that are putting pressure, especially putting pressure on the inflation rate, which in turn is affecting our market. And also going into an election year, as time has proved, our markets dip even further. So basically, I think once investors have confidence back in the economic growth and after the elections, when they go smoothly, we should see a lot more interest back in the market.
Okay, last week we got news of the central bank's decision to keep rates unchanged. I think that was quite a surprise for many people because there have been calls for further monetary tightening. What do you make of that decision first and foremost?
It was actually quite a surprise for a lot of the market. But in a way, I think I do agree with what the MPC did. Basically, what they were trying to do is they feel that they've actually tightened the market enough, and any further tightening would have had an adverse effect on commercial lending rates, because basically they still want the economic growth and they still want people to borrow. So far, we've seen banks moving up the base lending rates by up to 200 basis points. And I'm sure any further tightening would have had, I mean, the rates would have shot up by another 200 basis points. So banks would be lending at a base rate of 17, 18, and that's not what that's not what Treasury wants or the MPC.
Let's talk about those bank lending rates, because what they did decide to do is introduce a bit more loosening on the cash reserve position for banks. That should reduce their transaction costs, but effectively, will that necessarily result in an easing of those lending rates?
Not as much as we'd like, actually. That's why central bank has, for the last 2 weeks, they've been coming in to pump in liquidity through the reverse repo. But in the month of August and September, we expect quite a high number of maturities, both in treasury bills and T-bonds. So I think we should see CBK coming in less, and basically this should ease the situation.
Let's talk about results coming through, because one would have thought that stellar results on the part of particularly blue chips should give impetus to the market. It's not doing so, as we've said. But the discrepancy now between the blue chip banks like the KCBs and the equities that have showed very steep growth, double-digit growth in their half-year earnings, is a vast contrast to some of the smaller banks that are showing real declines, almost double-digit declines. Why this discrepancy, and what does it mean for their customers?
I think basically with the big banks, it was more or less expected, especially the banks banks such as Cooperative, Equity, banks that have really increased their customer numbers. Looking at the smaller banks, which have not been able to increase their customer numbers, most of them cutting their costs. Because what happens is when the margins thin out, the only other area that to help you out is cutting your costs. So basically, with the smaller banks cutting their costs, we saw the bigger banks coming out, increasing their branch network, agency banking. So most of these banks have benefited from increased customer growth.
Right. And just looking at the market movers today, we are seeing some of the insurers performing well, lots of activity and positive gains for Kenya Re, but also a 3.3% jump in the share price for Pan African. Why is that?
Basically, I think that would have to do with the valuation. Pan African actually has a lot of value. In fact, if you compare it with other insurance companies and also other upcoming insurance companies that are expected to come into the Nairobi Stock Exchange soon, it actually has a much higher value. I think investors have realized this and have decided to take up positions in it.
All right, now let's move beyond Kenya and what we're seeing internationally. sigh of relief as some sort of a bipartisan deal has been struck by Republicans and Democrats in both the Congress and the Senate, but as yet not a vote. That does not preclude America from a downgrade. What would that mean for Kenya? Because apparently, if there is a downgrade on American debt or sovereign position, it's going to have a lot of bearing on Kenya's ability to borrow. Why is that?
Basically, not just Kenya, but I think globally, a downgrade, and also, okay, at first we were actually scared of default, albeit technical, but a downgrade would also have quite an adverse effect on Kenya. But what we expect actually the vote to go through. We expect them to sit down and agree. Most of the Kenyan market actually did not expect technical default, and also we also don't see a downgrade coming through.
All right, and then just in terms of the economic outlook going forward, the idea that we would see some mitigation in the inflation rate, but that's not necessarily the case when it comes to growth. Authorities are bullish about growth at least being above the 5% mark, but as we said, you know, that's not convincing news for investors. So what's a realistic outlook for this economy?
That's actually true. I mean, the economic growth outlook is not looking too good. We expect it to slow down even further, especially since the power producers began rationing, power distributors actually began rationing electricity beginning last week. That's expected to have a much more adverse effect, especially on the manufacturing industry. And also in the coming month, we expect the fuel component of our electric bills to actually move up. This will increase the cost of energy even further compounding inflation. So the outlook is not too good, and food is another factor. I mean, it has the highest weighting in the CPI index, and this doesn't look like easing anytime soon, especially with part of the country going through a drought at the moment. So the outlook is not too good, but towards the end of the year, as the central bank has said, we do expect things may begin to look up.